Not every stock needs to be a guaranteed success. The same goes for ETFs. That's because by swinging for the fences every time, you may miss the chance of getting singles and doubles that add up over time. This brings me to the iShares Core Dividend Growth ETF, DGRO, whose well-balanced attributes make it a suitable ETF for a total return portfolio. While DGRO may not offer the highest yield like some of its peers, it does carry a durable attribute that will give an investor peace of mind. In this video, we'll explore what makes the ETF favorable for those seeking a mix of income and growth by analyzing its assets, performance, and other factors. Let's get started. Starting from the fundamentals, the DGRO, also known as the iShares Core Dividend Growth ETF, was launched on June 10, 2014 by BlackRock's iShares. It's a low-cost core ETF that exposes investors to U.S. companies with a consistent history of growing dividends. This stability and the potential for dividend increases make DGRO attractive if you seek long-term wealth accumulation. It's also for you if you're looking for growth at a cheaper price. We know stocks with growing dividend payouts offer the benefit of an increasing dividend payout over time. But beyond that, these companies usually have sound fundamentals, exhibiting solid earnings growth and profitability. So, by investing in dividend growth stocks, you're getting the dual benefit of owning dynamic, growing companies with increasing earnings and strong profitability that should be appreciated over the long run, combined with the bonus of increased dividend income over time. That's what DGRO offers. As of September 2023, DGRO's assets under management totaled $23 billion. Its dividend stands at 2.57%, and its annual dividend per share since 2022 has been $1.27. Also, its dividend payout is monthly, making it a consistent and frequent income stream. The market price of DGRO at the time of making this video was $49.69, which is a steal compared to several other ETF funds in the market. Another interesting factor of this fund is its beta of 0.89%, showing it's less volatile than the overall market. If you don't know, the beta value below 1 indicates lower volatility than the overall market, and vice versa. Now, let's look at the performance statistics of this fund over the year. Since its inception in 2014, DGRO has returned 147.47% with dividends reinvested. DGRO looks even more impressive when you pull the binoculars back to look at the long-term track record. Before the 2020 bear market, DGRO had beaten the S&P 500 since its inception. The fund is almost on par with the large cap index returns, even after the pullback. Also, during the start of the bear market in 2022, DGRO outperformed popular funds such as the S&P 500 and the SCHD by 4% and 2% respectively. Before diving into the fund's current portfolio details, let's evaluate the index DGRO aims to track, as this will influence future changes and overall performance. DGRO seeks to track the investment results of the Morningstar US Dividend Growth Index, a broad market index representing approximately 97% of the market capitalization of publicly traded US stocks. This index operates by selecting funds based on specific eligibility criteria. Requirements include a positive indicative dividend yield, the exclusion of REITs to provide qualified dividends, stocks with a minimum of 5 years of consecutive dividend growth, a positive consensus earnings forecast, a payout ratio below 75%, and an indicative yield not in the top 10% of the dividend screening universe. Let's look at what each criterion entails. A positive consensus earnings forecast signals analysts' anticipation of the company's earnings growth, influenced by factors like expected sales, market conditions, or industry trends. This optimism is generally viewed favorably, boosting investor confidence and potentially leading to higher stock prices and dividend yields. A payout ratio below 75% indicates that companies retain a significant portion of earnings for purposes like reinvestments, debt repayment, or future growth, prioritizing avenues beyond immediate dividend distribution. This emphasis on growth is crucial. The dividend screen universe comprises companies with the highest dividend yields, and by avoiding stocks in the top 10%, the fund steers clear of those with unusually high yields, mitigating risks associated with dividend traps and focusing on firms exhibiting strong growth characteristics. Besides the dividend yield it offers, DGRO is weighted by dividend dollars, which refers to the annual amount of money paid to shareholders as dividends. This is calculated by multiplying the dividend per share by the number of shares available for purchase. Consequently, the index naturally favors larger companies as they generate more dividend dollars, reshaping the portfolio towards these sizable entities that meet indexing criteria. As long as a company meets the index's criteria, it is included, resulting in companies with more considerable dividend dollars taking up a more significant portion of the portfolio. The fund's emphasis on more extensive cap stocks is somewhat counteracted by capping individual positions at around 3% of the portfolio. Looking at this diagram, you'll see that every holding on the fund portfolio, except Apple and Microsoft, take up 2% or less of it. Companies like JP Morgan Chase and Chevron only take up about 2%. Now, moving on to the fund holdings, DGRO boasts 446 stocks. This number provides a lot of diversity towards dividend-paying stocks. Representing 19.60% of the portfolio, the fund has the heaviest allocation of the healthcare sector. Financial, information technology, and consumer defensives are at 17.5%, 16.8%, and 11.2% respectively. Two of this fund's four most significant holdings are Microsoft and Apple, which show its growth potential and long-term returns. Although these tech companies aren't very generous with dividend payments, they have all combined strong performances with increasing dividend payouts in recent years, creating a winning combination for investors. For instance, Apple has increased its annual dividend payout for 9 years and Microsoft for 18, all while significantly appreciating their share prices. In addition to these tech leaders, you'll find blue chip names from various sectors in DGRO's top 10 holdings, ranging from JP Morgan Chase to Home Depot and energy majors like ExxonMobil and Chevron. Due to its vast diversity, the top 10 assets of DGRO only make up 27% of it. This can be very beneficial for you as an investor, especially during times of market downturn, as it will smooth out the market volatility. Also, there isn't much risk of concentration there. Let's play out an instance where you invest $50,000 in DGRO for 5 years. With the current yield rate, the return on your investment would be worth $65,823. So, for 10 years, the return on investment would be worth a whopping $162,528. Next, let's look at the dividend growth rate. This fund has grown its dividends over the last 3 years at 8.79%. Its 5-year growth rate is 10.32%, and the 12-month dividend growth rate is 12%. This consistent dividend growth rate signals the fund's financial stability and confidence in future earnings. Another factor that makes DGRO a fantastic fund option is its low expense ratio. When choosing a suitable ETF, the significance of the cost factor cannot be overlooked. A cheaper ETF with a lower expense ratio would perform better than most expensive ETFs. So, considering the DGRO expense ratio, it is about 0.08%. It implies that if you invest $10,000, the fund management at DGRO would cost you only $8, making DGRO relatively low cost. But despite all the advantages this fund offers, it has a downside. Two main problems this ETF faces in the current investing environment is that this fund has minimal holdings in crucial sectors that tend to do better in an inflationary environment. The fund also has significant holdings in the underperforming financial industry. The iShares Core Dividend Growth Fund has only 10% of the fund's assets in the energy and basic materials sectors combined. And this fund has just 10% of its assets in the industrial sector. The energy and basic materials sectors have been two of the best performing sectors in the market since prices began to rise significantly in early 2021, and energy companies have consistently paid out impressive dividend payments as well. Rising energy costs and increasing fees are also hurting a lot of retail companies in the consumer staple industry, and this fund also has 10% of the fund's assets allocated to that sector. Also, its dollar weighing method gives almost no weight to mid and small caps. However, it has the advantage of giving greater weight to the biggest cash flow generators. In general, those are the companies you want to fill out your dividend portfolio. With its low expense ratio, above market average yield, and diverse stock sections in top companies, DGRO can provide you with more downside protection and long-term growth. As such, it could be ideal if you're seeking an ETF that offers value and income. Remember to subscribe to our channel if you found this content valuable. I'll see you in the next one.